it does seem as though right now the gloves have come off in this debate.
You know, we expected a reaction, but we definitely seem to have hit a nerve. And I think the reason for that is that the existing exchanges no longer make much of their money from actually matching trades. That's what exchanges used to do. That's kind of what they're supposed to be in the business of doing. We're proposing a model that doesn't sell preferred access, doesn't rely on sale of market data. That's very threatening to the exchanges because if that model takes off, then it means that revenue sources that they've come to rely on are suddenly at risk. So I think that's why the reaction has been so strong.
There's a number of objections been thrown up, a number of obstacles. One of the more colorful was NYSE has said you're like the frozen yogurt shop in Seinfeld. You say you're low fat, but actually you're selling full fat.
The truth is, I think we're offering a different flavor than the New York Stock Exchange is, and I think they're a little worried that their brand won't taste quite as good if people decide they like that alternative. And so I think that's a better comparison than the one that they gave.
Nasdaq, for their part, has come out saying, well, they wanted to have a speed bump, but they couldn't under Reg NMS. And first you have to change the rules. You can't just make a loophole for IEX to come in.
Right. So I know about the Nasdaq proposal. It actually was not very close to what it is we're doing. And not to get too much into the weeds, our so-called speed bump applies to everybody who comes into the market, regardless of who they are or where they come from. It operates in exactly the same way. So it's a very different system. So I think Nasdaq's complaints sort of fall flat that they're being treated differently.